while we're out here in San Francisco, I think we need to check in with one of the most popular makers of connected devices on Earth. I'm talking about Fitbit, the #1 maker of wearable fitness trackers, a stock that's been on a real roller coaster ride since it came public 3 months ago, even as its business has been on fire. Fitbit initially exploded higher after its IPO, thanks to the company's staggering growth rate. But after they reported their first quarter out of the gate in early August, even though Fitbit beat the stuffings out of the Wall Street sales and earnings estimates, the stock nevertheless got slammed because it was priced for perfection. And though the results were excellent, maybe they weren't perfect, with the bears roaring about weaker margins and rapidly increasing marketing expenses. Fitbit kept going lower as part of the last month's epic sell-off in all the high-flying growth names. But yesterday, Fitbit suddenly announced a huge deal with Target, where Target will provide the company's most basic devices free of charge to all of its 335,000 U.S. employees, or subsidize Fitbit's more expensive offerings in order to help keep their employees healthy and happy. Fitbit moved from 33 up to 37 in the news yesterday, and it climbed again today. I think this deal's a game changer because it made it crystal clear that Fitbit is a health and wellness company with great technology, not just a device company with a fitness component. Even up here, you know what? I think it's worth buying, but do not take it from me. Let's check in with James Park, the co-founder, chairman, and CEO of Fitbit, to hear more about his company's prospects. Mr. Park, welcome to Mad Money.
Thanks, Jim.
All right, James, I thought that yesterday was a defining day, not just for one, because of the Target deal, but also because you are now compliant with HIPAA, which to me makes it so that you've got the right protections of privacy, and you've got the device that could save people millions of dollars, not just millions of pounds.
Exactly. So HIPAA is a big step forward for the company. It enables us to create deeper partnerships with corporations who are interested in the healthcare of their employees. And Target is a great example. Target is a leading U.S. corporation, and this is a huge priority for them to use technology to help save healthcare costs and improve the lives of their employees.
Why do you think they selected yours? I mean, we always hear that there are these other companies, whether it be Apple, Garmin. Why did they select Fitbit?
I think it's easy to characterize Fitbit as a device company, but we're a solution company around health and wellness. So we've invested a lot in our enterprise software offering. I think people don't know that, but when Target evaluated both our hardware and their software, they were pretty impressed, and then the HIPAA announcement was just the icing on the cake.
Data, inspiration, guidance. I think that all those, which I know that's some of your mantra, are suffused in the Target deal, but I love this competition that Target has and what it could only mean for charity.
Exactly. So Target is trying to incentivize their employees. So Target is giving away $1 million to charity as part of this employee competition. So it's great. Employees are super excited.
All right. Now, a lot of people are trying to figure out the size of this market. If it is just a device market, I don't think it's big. Health and wellness, 11 million units. What are the number of units it could only be if you have that mindset?
Look, consumers spend over $200 billion in health and fitness services globally. So I think Fitbit, as the leading company in this category, we're well positioned to take a lot of that spend.
Now, when Apple came out, there was some data which says that the watch is taking off. I think people didn't understand that it's not mutually exclusive, and also you partner with everybody.
Yeah, it's a huge market. Again, it's $200 billion spending. There's a lot of differentiation. With Apple specifically, our price points are different. Our target audience is different. We have a wide range of devices. We have a huge social network. We focus a lot on battery life. So there's a lot of differentiation there, but like you said, on partnerships, that's a key part of our success. We're very aggressive about partnerships. We have one with Kellogg's, with Tory Burch, Microsoft, even Weight Watchers.
BP?
BP, Target, et cetera. So all of that stuff has accelerated our growth.
I don't know if people realize it, but you actually make more money on a group deal like that because you don't have to give the retail discount.
Exactly. We have higher margins on our corporate wellness business. That's why there's such a big focus on it in the company.
Now, let's go back. When the quarter was reported, I got very excited about it. And then it turned out to be some gross margin issues. But, your CFO explained it the other day pretty well. It was really a highest of quality problems. It was demand and trying to meet it as fast as you could.
Exactly. Look at our explosive revenue growth. I mean, there's some FX stuff, but do investors want explosive revenue or slightly lower gross margins? I mean, we'll try to deliver both. But, I think we had a fabulous quarter.
Now, you are talking about a lot of different uses. You're talking about sleep and heart rate. Holy grail, perhaps, one day, blood pressure?
It could be. Again, a lot of investment in R&D, but, we're going to try.
All right. One of the things I'm trying to figure out is that people don't seem to get you have a software subscription model. It's not one and done.
Exactly. So we acquired a company called Fitstar a few months ago. So a big part of, again, our company's mission is about inspiration and guidance, and coaching is a big part of that. How do we use that data to tell people exactly what to do.
Now, protecting the security of healthcare is perhaps something that has been a gating issue. So your 35-person staff that can now go group, how does the sales pitch change post-HIPAA?
Look, it's going to allow us to make the pitch to employers and health plans that, look, we can sign more comprehensive agreements called BAAs with you, and that enables us to do more with the data. It enables us to have deeper integration, so I think everyone's really excited
But
about
ultimately, doesn't it allow you to get your healthcare bill down?
Ultimately,
yes.
Yes.
All right, well, that's why there's a lot of ways to win. This is a very exciting story, and it's a big discount from where it came just a few weeks ago. That's James Park, the chairman and CEO of Fitbit. This is a health and wellness company. It's not a device company, and that's why it should be valued higher than it is. Stick with Cramer.